Economics. Introduction to Business Economics. Economics is a science which studies about individual organization in a process of production, distribution, consumption. It is the general meaning of economics, and there are some few important definitions which may ask from the point of view of exam. So you have to remember the definition. Wealth definition. Wealth definition is given by Adam Smith in the books of nations. Important given important to material things, an inquiry into the nature and causes of wealth of nation. It is the book name. Main definition of economics, you can say accumulation, acquisition, expenditure of wealth is called economics. And another important definition is JB What is JB says economics is a science which studies about wealth. He says economics is a science which studies about wealth. Then Marshall definition comes. Alfred Marshall, wealth definition. What he says with material well-being definition. The principles of economics, he given primary importance to man and his welfare. According to Marshall, human welfare is primary thing, material study is secondary thing. He says that human welfare and human development is first, then material well-being. A.C. Pigou, he suggested and he supported Alfred Marshall's wealth definition, which is also known as material well-being definition. Lord Lionel Robbins, he gives scarcity definition, which we studied about when we are studied in our class 11th and 12th. Lord Lionel Robbins, scarcity definition. Science of choice making, an essay in the nature and significance of economic science. His definition imperialized on the choice of problem arises. It is universal but criticized as imposed. Economics is a science, universally applicable, systematic body of knowledge, ability to forecast, capable of measurement. Science is a theoretical, but art is a practice. Science which teaches us what to know, but art us how to do. Difference between positive economics and normative economics. In this also you will get a question in MCQs. It studies about only cause and wealth relationship. It does not pass any value judgment. Positive economics, what it is, what ought to be. It is a descriptive, it is a prescriptive. It studies about economic as a whole, individual economics of units of economy, microeconomics, small, macro, large. Individual units of economy, economy as a whole. In microeconomy, we can see the in macroeconomics we can see the total employment, balance of payments, growth rate, etc. It is also called as price theory, slicing method theory. Macroeconomics is also called as income and employment theory, lump sum method. In macroeconomics, you will get to know the GDP, gross domestic product, national income. Central economics problems, what to produce, how to produce, whom to produce, what to produce, how much should use to produce. It is related to allocation of resources, capital intensive sectors or labor intensive techniques, how to produce, techniques of productions. We discussed in the fast capital intensive or labor intensive. Whom to produce, to whom we have to produce the goods or services. First of all, what to produce, what we have to produce, and how much, how to produce, from using which techniques we have to produce, either a labor intensive techniques or capital intensive technique. Whom to produce, for whom. In generally in society, we, the manufacturer decides that a product, particular product which is sold to whom to produce. Distribution. In any economy, if the resources is allocated only for the production of consumer, the present consumption will be in future growth cleans due to less capital good availability. Then capitalistic economy, it is also known as free market economy, laissez faire economy, uncontrolled economy, unregulated economy, unrestricted economy. Fundamental future is private ownership of property. In capitalism, the ownership remains in the hands of private. Profit is the primary motive in capitalistic economy. Private individual participation is highest level. Private sec- Private price mechanism plays a key role. Income and wealth inequalities are high. Full employment is guaranteed, but there is no security. Business cycle fluctuations are high. Business cycle fluctuation means sometimes there is growth, sometimes there is expansion, sometimes there is peak, sometimes there is contraction, sometimes there is draft drought. Availability of substitute in the market are more. Generally in capitalistic economy, there are the power in the hands of private owners, so number of people can buy and number of people can start businesses, startups, and they may produce product, different kind of product, based on the quality and quantity, sustainability, market forces, and they will keep a view, and everyone create the resources according to the ability of their capital and give to the people for money. So there are more substitute in the market according to the needs of the individuals. High growth rate, the growth rate will be very much high. There are class conflict between employer and employee owner of the, there may be wastage of resources sometimes, and consumer sovereignty exists. Consumer sovereignty is very important in the business management. Socialism, it is also called as controlled economy, combined economy, centrally planned economy. In socialism, you will see that the state ownership of property existed because the government will control the ownership. Welfare is the primary motive. The main fundamental feature of socialism is welfare. Welfare is primary motive. Minimum role of private price mechanism. There is less role of price mechanism of private individuals. All the major decisions regarding to the price, everything is taken by the government and fixed by the government. Income and wealth inequalities are very less, but you cannot see in realistic there is full much of income and wealth inequalities. Employment is provided, there is a security in government, but occupation is restricted. No consumer sovereignty, there is no consumer sovereignty will exist. The buyer cannot sovereign himself. Less business cycles, limited competition, less growth rate, better utilization of resources. No monetary incentives will be provided. Domination by nepotism and domination. Mixed economy, coexistence of private and public sector. Capitalism and socialism equal to mixed economy. Dual pricing system, administered price structure, growth rate is moderate, less business fluctuations. So in India, you can take example as a India mixed economy. Capitalism, you take economy as USA, UK. Then second unit, theory of demand and supply. Demand refers to the reputation that a customer is giving to a product to a given price in the market in a given point of time. Suppose a mango is there in summer and a consumer go to the mango purchaser vendor and he asks for 10 rupees and the vendor says it is 15 rupees per kg, and the consumer again asks give to 13 rupees. It is the 13 rupees is the reputation that a customer giving to the product to a price in the market a given point of time. Determinants of demand, characteristics of demand, price of a commodity, P of X, income of an individual, taste and preferences, price of related goods, other factors, population segment, distribution of income, wealth, demonstration effect, bandwagon effect, demand function, functional relationship between demand of a product and various goods, P of X, Y, TP of SS, and other sources, price of a commodity, income of an individual, Y is denoted as an income, T is equal to taste and preferences, prices of substitute goods and other sources, price demand, D of X is equal to F of P of X, price of commodity. When price decreases, demand will increase. You can see when price is 5, the demand for the product is 1. Individual demand schedule. Market demand is obtained by horizontal summation of individuals demand of a single commodity, and the demand curve is curvilinear. um Law of demand, old and new buyers, law of diminishing marginal utility, income and substitution effect, the multiple uses of a commodity, exemption to the law of demand. There are some exemptions. Given goods are exempted. Veblen goods are also exempted. Necessities exempted. Rational and irrational, ignorant custom sometimes, irrespective of the demand and price of a product, the consumer will buy. So these are the exemption to the law of demand. And very important thing, changes in demand. Changes in demand due to changes in price. It is explained by the movement along with this same demand. Upward contraction, downward expansion. Changes in demand is explained through shift. Rightward shift, demand increases. Leftward shift, demand decreases. Here you can see rightward shift, demand increases. Leftward shift, demand decreases. Rightward up to downward movement, expansion. Upward movement, contraction. Yes, there are some important distinctions: competitive demand, substitute goods, joint demand, complementary goods, composite demand. A good can be combined for various purposes. Autonomous demand, independent and isolated. Derived demand, demand of one commodity depend on others. Price of production. Short term demand, it is due to frequent fluctuations in the price, the demand is relatively less. Long period, demand is relatively high. Film and industry demand and price elasticity. Demand refer to the percentages of changes in demand is equal to percentage changes of a person. Electricity demand is measurable concept, quantitative. ED, changes in percent demand. Quantity demand is equal to percentage changes in delta in price. So you can see the various example. Perfectly price elasticity demand. Inelastic unitary elasticities, related goods and price method, geometrical method, arc method, midpoint method. And this is a formula where you can get 1 mark easily. Delta q by delta p into p by q for price method. Delta q, changes in quantity demand is equal to changes in price into p by q. P, original price, original quantity. The demand of fall by 196 when its price increases 5 to 6. Equilibrium price is also called as market clearing price. Supply curve is sloped left to right due to rationality of a seller. Law of supply does not apply in the case of land, rare goods, aquatic goods, and sellers irrationality. P by Q. Quantity demand price. And here you can see some example: price, quantity, 20, 50, 18, 16. Delta Q by delta P, changes in quantity demand, 20, 50, 50, 60, 10. Changes in price, 2. Delta Q, delta P, 20, 50. There are some other examples such as characteristics of human wants. Some wants are some wants are substituted, some wants are complementary, some wants may be changed into hobbies, some wants different from person to person's necessities, conventionals, comforts always lies between necessities and luxury, superior and very expensive. Utility. The want satisfying capacity of a commodity is called utility. Anticipated satisfaction derived from a consumer before consumption, but the original satisfaction is only derived after the consumption of a commodity. Utility is a relative subject and subjective concept. It is always ethically neutral. There are terms forms of utility: form utility, size, shape, color, etc. You can see example of a utility: when wood is in the state of unshaped, there is no utility, but the same wood is make into chair, cupboards, doors, so it will get utility. Place utility. So in a garden, some flowers are bloom. At that time there is no utility, there is no demand for that product. But when the same flowers are brought to market and there will be utility, there is a number of people will come and bargain and buy those flowers. Place utility. The place of the product decides the utility. Service utilities. So there are many kind of services provided by the many persons. Time utility. For example, cold drinks will have more demand at the time of summer. Umbrellas in rainy season. So most important thing is marginal utility. Consumer is very rational. Cardinal utility. 1, 2, 3 for ordinal. First, second, third, fourth. Law of diminishing marginal utility. Marginal means additional. So if a consumer consumes goes one more utility of a unit of commodity, the additional satisfaction derived from the consumption of additional utilities, the commodity will decrease. Rational consumer, all the units of commodity are homogeneous. There is no time gap in the consumption. There must be standard units consumption. There must be standards. There are many forms that will be made on it. And limitation: money, hobbies, durable goods, and consumer supplies. The concept of originally Professor duped profile by Alfred Marshall, and willing price minus actual price. surplus. So he's willing 50 rupees and actual price is 40. The difference is 10 rupees. It is called as consumer surplus. He will save that money. Ordinal approach. Hmm. It is important thing you have to note it. I'll just pause for a few seconds. Make sure then budget line. This will also just thoroughly read it, and this will also thoroughly read it. Then pure perfectly oligopoly, homogeneous goods, differentiated, heterogeneous, open, free entry and free exit, closed, blocked entry, partial, large domination of firms, full, collusive, group of people formation and they fix a price, non-collusive, organized, syndicated group of people only for price. In a kinked demand curve is kinked. Business cycles. They are recurrent and occurs periodically. They occurs again and again, but not always in regular intervals, and they do not same length. Fluctuations are very common. Sometimes there is a expansion. Sometimes there is growth, peak, contraction, recession, drought. So likely, and same if sometimes there is expansion, there is not always expansion at all the times. They do not occur regular intervally. Business cycle is generally originates in free market economy. Free market economy is also known as capitalistic economy, regulated economy, uncontrolled economy, developed economies. The business cycle are pervasive in nature, widespread in nature. They are highly contagious. Business cycles creates a disproportionate effect on the sector, especially capital goods, consumer durability. Complex in nature, very serious on the well-being of society. There are four phases of business cycle: expansion, peak, contraction, drought, recession. So there is recovery before depression, drought, recovery after expansion. There is an increase in the business cycle. Then peak will reach. Then contraction. Contraction falls under the recession to depression or drought, then again recovery, expansion, then again peak, contraction, recession, depression. So these business cycle fluctuations are very common in any kind of economics, but they do not occur at regular intervals. Regular intervals in meaning, for suppose there is expansion, then there is a peak. So these two does not occur in the same format as I am studying and explaining to you. For this example, there is expansion. After some time, there will be draft. This is the study broken line in the middle. Characteristics: increase in national output, unemployment, aggregate supply, increase in sale profit, increased credibility. You can thoroughly read it. Peak: it remains the pop highest position. Cost of living increases, greater succession and fixed income earners. The economy cannot continue to grow endlessly. Peak occurs when economic growth reaches to a point where its stability for a short term the moves in a reserve direction. Contraction: there is a fall in the level of investment and employment. Recovery: expansion. Peak: contraction. Producers do not recognize the pulse of the economy and they anticipated higher levels of demand. Supply is more than the demand. Depression drought: it is a severe form of recession. Growth rate becomes negative. No more jobs, unemployment. Individuals are left with very less income. Many companies forced to shut down their operations. Decrease in the interest rate. You will get a question from these indicators: leading indicator, lagging indicator, concurrent or coincidence indicator. Causes: internal cause, external cause. Internal cause: fluctuations, demand, changes in investment, changes in money supply, changes in government expenditure. Psychological factors: war, post war, technological changes, natural calamities, earthquakes, population growth, etc. Public finance. Public finance is one of the most important chapter in the business economics. Mainly there are two topics: fiscal functions, fiscal policy and monetary policy. Fiscal policies are set by the government. Monetary policies are set by the RBI, Reserve Bank of India. The actions of government have input on economy: borrowing money, public welfare, government expenditure. Three main macroeconomic goods for any nation: economic growth, high level of employment, stable prices. Government has to intervene in all the above matters taking decisions. Role of government in economy is very important thing. Then comes to economic system which provides this is the basic of first lesson of introduction to economics, where we talks about what to produce, how to produce, whom to produce, in what to produce, what kind of products we have to produce, how to produce, how we have to produce the products or raw materials or finished goods by using labor intensive techniques or capital intensive techniques, for whom to produce, for elites, for poor peoples, or for lower middle class peoples, etc. Three economic type systems: capitalistic economy, socialistic economy, mixed economy. In capitalistic economy, there is a capitalistic economy is also known as laissez-faire economy, uncontrolled, unregulated economy. Socialistic economy, where the government plays key role in decision making. Mixed economy, dual pricing system. Such things exist in mixed economy. All these factors contribute in public finance. Famous Adam Smith. Adam Smith favored free market economy, that is capitalistic economy or laissez-faire economy. But the role of government should be in the national defense, justice system, public institutions and public works. Public institutions means educational institution, health, medical institutions such as government hospitals, and public works. What is public works? In the government intervenes, the government should be participate in look after in public works. Public works means building of canals, roads, bridges, dams. Through that dams we can get water, drinking water, or electricity from that kinetic energy, and farmers get sufficient water from that. (1930) Great Depression. After this, government role in the gain importance. Government performs economic functions: fiscal policy, public finance. Richard Musgrave. 1959. The theory of public finance introduced by three-branch taxonomy of the role of government in resource allocation, income redistribution, macroeconomic stabilization. Allocation functions: optimum allocation of resources for maximum satisfaction, minimum wastage, minimum inefficiency. Private sector, market economic, consumers opportunity exist, role of demand and supply. Public goods will be less, merit goods will be less. Government decision, merit goods will be more, public goods will be more. Efficient allocation takes place in perfectly competition market, but in reality no perfectly competition does exist. There are some inefficient allocations and reasons we have to look after for the reasons: imperfect competition, leak of public goods, incomplete market, overuse of resources, externalities, factor of mobility, inequalities of income. Then according to Richard Musgrave, the government should intervene in market to bring about resources. Resource allocation of government policies, functions, improve tax proposals, what to produce, how who and what shall be taxed, how much on government revenue should be there, optimum utilization of social goods, public goods plus merit goods. Then comes to a variety of allocation investment available by government, such as influence resources allocation. Government may directly produce economic goods like electricity. Government may influence through legislation forces. Government regulate activities is called licensing. Redistribution function. Income and wealth is keyword. A function relates to whom, for whom to produce. This function is also relates to the manner in which effective demand over economic goods is divided among various individuals. Redistribution of income, social welfare, provide equality of income, provide security, progressive taxes, unemployment benefits, FCI for BPL, efficiency versus equity, upliftment of truth. Greater equity can be advanced through high taxes on rich, but it could not be act as a disinvestment to enterprises and disclosure from people making saving investments. Stabilization functions. Output is equal to production capacity. Spending is equal to total output. Labor is equal to full employment. Inflation is low and stable. For example, monetary policy and fiscal policy. I will explain simple in 2 minutes about monetary policy and fiscal policy. Monetary policy is run by the set by the RBI, Reserve Bank of India. When RBI wants to increase money supply, they will reduce taxes. When RBI wants to decrease money supply, they will increase interest rates. Stabilization, stagflation. Sometimes there is unemployment and inflation. It is also known as stagflation. And stabilization is a function concerned with labor, capitalization, etc. Monetary functions, they have to look after for it also. CA Foundation, Business Law, Indian Regulatory Frameworks. In this chapter, the important questions are source of law. You may get theory question from source of law. And one of the most important topic is types of laws in Indian legal system. Criminal law. Criminal law means which relate to violation of rule of public wrong. Indian Penal Code 1860, Code of Criminal Procedure 1973. Some of the best examples such as criminal law, we can see murder, rape, theft, fraud, cheating, assault. Civil law. Civil law means civil dispute. Civil dispute means fighting between two persons, landlord and tenant, breach of contract, defamation, etc. Common law. A judgment delivered by the Supreme Courts will be binding upon the all courts within the territory according to the Article 141. One of the most important topics and most repeated topics is Ministry of Finance, Ministry of Corporate Affairs, Ministry of Home Affairs. And you may get a question from Supreme Court, High Court, District Courts. In Indian judicial system, there are three kind of courts are there. Supreme Court is the apex means topmost, and we use Indian High Court, Supreme Court, which is the topmost body of judicial system. It was established on 26 January 1950. Chief Justice of Supreme India is the highest authority appointed under Article 126. Who appoints Chief Justice of Supreme Court of India? The President of India appoints the Chief Justice of Supreme Court of India. Principal bench of Supreme Court consists of 7 members, including Chief Justice of Supreme Court of India. In past, there are 7 members, including Chief Justice of Supreme Court of India. But now the strength is increasing, the people is increasing, the problems are increasing, the cases are increasing. So, keeping in a view of them, the Supreme Court has increased 34, including Chief Justice of India present. An individual can seek justice from Chief Justice of. If the fundamental rights of the citizen is threatened, then the citizen has the right to go to the court of law and fight and writ petition. Writ means highest order to protect the fundamental right of that citizen by the Article 32. A citizen can seek justice from the court. High Court. High Court means highest court of justice in the state. Article 241. Every state must have a High Court. There are 6 High Courts with jurisdiction more than 71 states and union territories. The oldest court in the country is Calcutta High Court. Second, district courts. Not more suits valuing not more than 2 crores. They take decision below the 2 crores rupees matters relating. Most important chapter in the CA Foundation Business Law exam is Indian Contract Act 1872. Nature of contract. What is contract? Contract means an agreement which is enforceable by law. When two persons make an agreement and that is which is enforceable by law. Enforceable by law means it is written in nature. It is written either agreement or in local. Then we have to take some steps according to that. Indian Contract Act 1872 was enacted on 25th April 1872. Came into force on 1st April 1872. Extended to whole of India, including Jammu and Kashmir after 370. It is based on the English common law. It is centrally related to law. Promise. A promise when is accepted becomes promise. Consideration. Consideration means something is written. An agreement. Every promise is set by for some consideration. Proposal plus acceptance plus consideration. Offer. An agreement which is enforceable by law. Agreement enforceable by law. Enforceable by law means it should be in the matters relating to the law. It should not violate any code of conduct or law. Limits in law, the agreements. Agreement enforceable by law. Offer. When a person signifies another person his willingness to do or abstain anything with a view to obtaining the assent of other, such act or acceptance is made. A proposal when accepted becomes promise. Two parties. There must be at least two parties making the offer. Intention to create legal relationship. There must be an intention to create legal obligation on parties between themselves. They must have an intention to go to the court of law if the other party does not meet the promise. Normally in social or domestic agreements, there is no intention to go to court of law, so they do not get results. For example, Balfour versus Balfour. A husband. So I will tell you one of the best example. So I will tell you the one of the best example which has been said by the many peoples. A wife is there. Wife and husband got divorced. When husband promised to pay monthly amount as a maintenance to the wife, suddenly he stopped paying the monthly amount. The wife went to the court and sued for him for the money recovered. As it is social agreement, there is no intention to create agreement between the parties because they didn't made an agreement while preparing bond papers. They are simply said in terms of words. The words are not treated as a legal documents or legal things in the case of wife and husband. So the wife will be lost. She does not compensated with the monthly amounts. A husband agrees to pay some of certain amount as a maintenance for every month while he was abroad. The husband failed to pay the promised amount. Wife sued for him for the recovery of the amount. Hence, he couldn't recover as it was a social agreement and the party does not intend to go to the court of law. Another example, Mr. A sold certain goods to B on credit 1 month. Here A intended to create legal relationship with B. On the expiry of the credit, Mr. A can sue Mr. B in the court of law in the failure of to fulfill the obligation of contract. Free consent. A consent is said to be free when it is not caused by coercion, undue influence, fraud, misrepresentation, mistake. Coercion, undue influence, fraud, misrepresentation, mistake. Capacity of parties. Every person is competent to contract who is attained the age of majority sound mind, not disqualified by law. Capacity of parties means every person is capable for making contract except who is below the age of majority. Majority means who has not attained the age of minority, who hasn't completed the age of 18 years. Then again, sound mind. The person should be sound mind. He is not be deaf, dumb, or any other healthy relatives, and not disqualified by any law. A person for being competent. Lawful consideration. Consideration means something in the consideration must be lawful. Lawful means, for suppose A and B make agreement. A promise to pay some amount to B. If B supply some cocaine, so it is not lawful consideration. Here cocaine is consideration, but it is not a lawful consideration. Supply of drugs, cocaine, and intoxicating drugs is prohibited under Indian Constitution. So it is a not lawful consideration. Consideration is something in written. For example, I will explain you the best example of lawful consideration. Mr. A went to car washing showroom and given his car to Mr. B for services, and Mr. B offered 5,000 rupees to service the car. Here 5,000 rupees is consideration for Mr. B. Car cleaning is service for Mr. A. It is a lawful consideration. Agreement does not explicitly declare void. An agreement involved valid contract. An agreement which satisfies all the elements of Indian Contract Act 1872 is valid. Voidable contract. Aggrieved party has the right to make the contract valid or void, which is not enforceable by law. Illegal agreement. Collateral agreement. Contract on the basis of creation or formation. Express contract. An agreement made by the words spoken or written is called express contract. Implied contract, other than words spoken or written. Static contract, something that is not expressed but stated, but rather than implied. Washing machine, withdrawing cash from ATM, sale by fall of hammer and auction sale. Quasi contracts, obligations are created by law. Rules for valid offer. Intention to create legal relationship. Certain and ambitious. Proper must be communicated made to the offeree. The offer must be made to the offeree and the offeree must reject or accept the offer. Offer is different from invitation to offer. Harris versus Nickerson. Case law. A statement of price tag is not an offer. Display of goods in a shop for a sale with the price tags attached on article. One customer selected the goods, but the owner refused to sell. It was held that the display of goods was only invitation to offer. The selection of goods was offered by the customer by to refusal and rejection of offer. Hence, there is no contract between the offerer and offeree, and the customer had no right to sue the owner. Offer may be expressed or implied. Offer may be general or specific. Offer may be positive or negative. Offer may be conditional. General offer. A general offer is one which is made to the whole world or public at large number of people at a specification. A general offer can be accepted by any person by fulfilling the terms of the offer. In case of general offer, the contract is made with the person who is having the Carlyle versus Carbolic case law. Carbolic Smoke Ball Company advertised in the newspaper that it will pay £100 to anyone who contract with influenza after using the smoke ball according to the company printed instructions. Mr. Carlyle used the smoke ball and printed the direction, but supplementary contacted influencer. On the sue of reward, she was entitled to recover the same because she accepted the offer by fulfilling the terms of the offer. Specific offer. Specific offer is one which is made to a specific person or particular person. A specific offer can be accepted by only specific defined person or that particular group of person. No other can make the contract other than whom the offer is it has been made. It is known as special offer. Bolton versus John. Counter offer. Counter offer in simple. Offer to an offer is called counter offer. Cross offer. Two offers which are similar in all aspects. Standing offer. Open offer. Counting offer. An offer which remained to open for a period of time is known as standing offer. Tenders are invited for supply of goods kinds. Absolute and unified. Manner of acceptance. Consequences of not accepting the offer in the prescribed manner. Communication. Time limit. Lapse of offer. Who is the age of 18 years? Sound mind, not disqualified minor. A minor is a person who has not attained the age of majority, according to Section 3 of Indian Majority Act 1872. Validity. An agreement with minor is void ab initio. Void ab initio means void from the beginning. సో ఒక అగ్రిమెంట్ ఒక కాంట్రాక్ట్ విత్ ది మైనర్ ఈస్ వాయిడ్ అబ్ ఇనిషియో. వాయిడ్ ఫ్రమ్ ది బిగినింగ్. చెల్లదు. ఎవరైతే ఈ 18 సంవత్సరాలు నిండిన వారితో అగ్రిమెంట్ చేస్తారో ఆ అగ్రిమెంట్ చెల్లుబాటు అగ్రిమెంట్ కాదు. ఆ అగ్రిమెంట్ నుంచి ఫర్దర్గా లీగల్గా యూ కెనాట్ క్లెయిమ్ ఎనీ కైండ్ ఆఫ్ థింగ్స్ బెనిఫిట్స్. ఒక కేసులో చూద్దాం. మోహిరి బీబీ వర్సెస్ ధర్మోదర్ ఘోష్. Dharmodar Ghosh borrowed a sum of money from Mohiri Bibi, executing a mortgage of his property in the favor of subsequently becomes a major suit setting aside mortgage which executed during his minority. The Privity Council section held that Section 10 and 11 of Indian Contract says an agreement with minor is void ab initio, void from the beginning. So, agreement chelladu. Mortgage was not valid. Mohiri Bibi paid to refuse them by the minor. It was held that the money advanced to minor cannot be recovered as because minor's agreement is void from the agreement. No ratification on the attaining the age of minority majority. An agreement with a minor cannot be ratified even after attaining the age of majority. Minor has a partner. According to Section 30 of Indian Partnership Act 1932, with the consent of all partner, minor can be admitted in the benefit of partnership firm. He can enjoy profits but does not liable. Minor can act as an agent. He will be not liable to his principal for his act. He can be draw, deliver, endorse negotiable instruments without himself being liable. A minor cannot be shareholders of members. If by mistake the member, the company can rescind the transaction and remove his name from the register of members. Lawful consideration. Minor has an insolvent. A minor can never be declared himself as he is incompetent to counter any dues are payable from his partner. Price determination in different markets. Market definition of market: a place where goods and services produced. Free goods. Free goods means freely supplied goods. You don't have to pay cost for it to render the service. Economic goods, not free goods. You have to buy for it. Economic market. Only exchange of goods and services is called goods. So here we check purchasing power of an article is expressed in terms of money. Elements of market: buyer and seller, product or service, bargaining price, knowledge about market conditions, one price per particular product at a given time. Classification of market: factor market, goods and services, product market. Types of market on the basis of area: local market for perishable, regional, semi perishable, national, durable, international, precious. On the basis of time: very short, short, long. On the basis of time, in very short period the supply cannot be changed. Like you can say, I don't have an example right now. Short, supply can slightly, supply can change. Very long, supply can easily change. On the basis of transaction: spot, goods are physically transferred on spot. On the basis of regulation: regulated market, unregulated market. On the basis of volume: wholesale market, bank quantities, retail market for ultimate consumer, small quantities. On the basis of competition: perfect competition, imperfect competition, monopoly, monopolistic, oligopoly. Basic concept: total revenue, price into quantity. Delta total revenue by delta Q, TR by Q. You can get a question from this. Perfect competition. Very large number of buyers, sellers, homogeneous products, free entry and free exist, knowledge of mobility, NLKOT, land, labor, capital organization. Average revenue is greater than average cost, abnormal or supernormal. Average revenue is equal to average cost, normal profit. Average revenue is less than average cost, losses. Marginal revenue is equal to marginal cost, profit maximization, producers equilibrium. Long this point shows optimum cost for operating at levels long run equilibrium of industry firm and normal profit. Marginal revenue, marginal cost is equal to average revenue. Consumers pay minimum price. MC is equal to AC. Marginal cost is equal to average cost. Normal profit. Marginal revenue is equal to marginal cost. Consumers, producers equilibrium. Price maker. Restriction in entry. No close substitute. Cross electricity. Producer equilibrium. Marginal revenue is equal to marginal cost. Profit under monopoly. Abnormal. In long run, monopolistic can hit the optimum utilization at a suboptimal level. Strategic control, government granting rights, business combination like price discrimination to earn maximization to capture foreign policy to enjoy economics of scale. Degrees of price determination, it is important. You may get one question. First degree, price is entire consumer supply. Mhm. Price is such that it takes entire consumer supplies. Second degree, only a part. Third degree, look, price varies because of location or consumer segment. Large number of buyers and sellers. Product differentiation. Heterogeneous, similar, close substitute, flatter. ED is less than 1. Free entry and exist. AR is equal to AC. Huge selling cost. Non-price equilibrium. Equilibrium profit maximization. MR is equal to MC. Marginal revenue is equal to marginal cost. Producers equilibrium. AR is less than AC. Abnormal, so AR is equal to AC. Normal. AR is less than AC. Oligopoly competition among few. Strategy. Group behavior. Price rigidity. Product may different from very difficult huge response. Types of oligopoly: perfectly homogeneous, differentiated, heterogeneous, open, neophyte, closed, entries restricted, collusive, common decision, non-collusive, complete with itself, partial. Industry is dominated by large firm. Industry is dominated by large firm. Full, no leadership, syndicated, small groups control, that is centralized, organized. All firm decides the centrally. Demand curve. Due to price rigidity, the demand curve is kinked even below. Electricity demand is less greater than equal to 1. Flatter. Electricity is less than 1. Steeper. Marginal revenue is equal to marginal cost, that is producers equilibrium. one of the most important thing. Counter model. Each film decides its output. So, Stackelberg's leader decides the output. Better and mode. Each film decides its price. Duopoly. Two sellers. Monopoly. Monopoly. Single buyer. Few buyers. Oligopoly. Bilateral monopoly. One buyer and one seller. Duopoly. Two sellers. Monopoly. Single buyer. Oligopoly. Few large buyers. Bilateral monopoly. One buyer is there, one seller is there. Once recap the entire chapter again. Marginal cost is equal to average cost. Consumer space equilibrium. Marginal cost is equal to average cost. Plants are used fully. Average revenue is equal to average cost. Films earned a normal profit. Marginal revenue is equal to marginal cost. Producers equilibrium. Profit maximization. So, perfect price determination in different market. What is market? Market is a place where goods are purchased or sold. There are two types of goods. One is free goods. Another one is economic goods. Free goods are such as air, water, sunshine, etc. These are free goods you can consume without giving something in terms of money or anything. Economic goods means which is not free. So suppose you have to buy a pen, you have to pay a particular price or something for it to to enjoy that kind of service. Mark In the market only exchange its value, that is sentimental value, price. Purchasing power of an article is expressed in terms of money. Elements of market: buyer and seller, product or service, bargain price for price, knowledge about market conditions, one price for a product at a given price. Classification of market: according to market, goods and services are produced. Product market. Types of marketers. There are different types of marketers you can see in the locals. One is on the basis of area. On the basis of area, you can see local market, regional market, national market, international market. You can see in local market for perishable goods, regional market semi-perishable, national durable, international precious. Precious means luxury, which is you can say gold, diamonds, silvers, antique goods. On the basis of time, very short period, short, long, long. Supply cannot be changed. In very short period, the supply it cannot be changed. Short period supply can change, right? Supply can change. Supply change. Spot market. On the basis of regulation, regulated market like stock exchange. On the basis of unregulated, no regulated. On the basis of falling, wholesale market and retail market. Another one you have to take on the basis of competition. Perfect competition, imperfect competition. Perfect competition, you can see that monopoly, monopolistic competition. Oligopoly. Monopoly means where a single seller, single where a film decides its output and price is called monopoly. Monopolistic. There are various groups of companies and films decides a price. Same product and differentiated products, like there are same soap but face value and different kinds of shape is different. Oligopoly. Few films decides. You have to check another one is basic concept. Total revenue price into quantity. How much price and how much quantity is there. For suppose you have your price is 2 rupees for each pen. 100 2 into 100 200. Marginal revenue delta TR by delta Q. Average revenue. Then you have to check marginal revenue is greater than equal to 0, that is Total revenue increasing at a diminishing rate. Marginal revenue, total revenue maximum. Marginal goes revenue goes negative. Total revenue falls. ED is less than 1. Very large number of buyers and sellers, homogeneous products, free entry and exit of goods. Firm will earn normal profits, perfect knowledge of markets, free mobility of NLKOT, land, labor, capital, organization, no selling or transport firms. Firms are price takers. Profit maximization for producers equilibrium. Marginal revenue, additional revenue is equal to marginal cost. Produces equilibrium. Rising portion of MC is supply curve. Abnormal profit. Average revenue is greater than average cost. Supernormal profit. Where when the revenue increases over average revenue increases over average cost, then you will get profit maximization. Normal profit, average revenue is equal to average cost, then you will get normal profit. When the average revenue falls average cost, you will get losses. Long run equilibrium, this fund shows optimum cost of operating q level optimization. Long run equilibrium of industry, all firms and non-profit, no entry, no exit. So, marginal cost is equal to average cost. Marginal cost is equal to average cost. Produces equilibrium. Marginal revenue is equal to marginal cost. Average revenue is greater than average cost. Abnormal, supernormal. Average revenue equal to average cost. Average revenue is less than average cost. Losses. Long run monopolistic can earn abnormal profit where average revenue is greater than average cost. In a long run monopolistic competition, optimum utilization, they can earn at sub optimum level too. How monopoly arises. Strategy control, government granting rights, business combinations like cartel, large startups, anti-competitive parties, predators, limit price levels, price determination, objectives to earn profit maximization, to capture foreign markets, to enjoy economic scale of disposal of excessive. Price discrimination is possible only when the following conditions is equal to submarket. Elasticity demand is less than 1. Price is very high. Elasticity demand is greater than 1. Price is low. No market attribute. Ab- arbitrage. Degrees of price determination. You will get AC Pigo suggested by. You can get a question from these three degree of competition. First one is first degree. In first degree, price in such a price takes entire consumer supply. In first degree, the the consumer's profit surplus is taken by the entire profit is taken in first degree. In second degree, a part of consumer surplus is taken. Third degree, location and consumer segments matters. Monopolistic competition, large number of buyers and sellers, product differentiation, heterogeneous goods, close substitute, ED is greater than equal to 1, flat curve, flatter curve. Free entry and exit of a film, huge selling cost, price return, non-price competition, marginal revenue is equal to marginal cost, producer equilibrium, profit maximization, same abnormal profit, average revenue is greater than average cost, abnormal or supernormal profit, average revenue equal to average cost, normal profit, average revenue is less than average cost, losses, oligopolistic, few number of buyers and sellers, competition among few, 2 or 10, strategic independence, group behavior, price liquidity, product may be homogeneous or heterogeneous, very difficult, huge selling cost, types of oligopoly, pure perfect oligopoly, homogeneous product, differentiated oligopoly, heterogeneous product, open oligopoly, new film can enter, closed oligopoly, restricted entry of new films, collusive oligopoly, commonly decide price and output, non-collusive, competition with others, partial, industry is dominated by one large film, partial, Indian industry is dominated by one large film, full, no leadership, syndicated means a group, small groups control, that is centralized body, organized, all from decided centrally. Demand curve, due to demand price liquidity, demand curve is kinked given below. ED is greater than 1, flatter, ED is less than 1, steeper, price is rigidly checkered price, profit maximization, marginal revenue is equal to marginal cost, counter model, each film decides its output, Stackbeggars, leader decides its output, Berners-Lee, film decides its price, duopoly, two sellers, monopoly, single buyer, few buyers, one buyer, one seller.